All right, let's get right into it. Right now, central banks are walking this incredibly thin tightrope, and you can bet investors are holding their breath. The rest of 2025, it's all about one massive conflict. So today, we're going to break down exactly what that means for your investment playbook. Okay, let's dive in.
It really all comes down to this one huge question. Recession or inflation? Which one is it going to be? Should central banks start slashing interest rates to fight off a recession, or do they have to keep rates high to battle this surprise comeback of inflation? The path they pick, well, it's going to create some very clear winners and losers in the market, no doubt about it.
So, here's what we've got on tap. First, we'll look at the economy's crossroads. Then, the two possible paths, the growth bet and the inflation fight. After that, we'll dive into an all-weather barbell strategy. And we'll wrap up with an investor's dashboard to help you keep track of it all.
Okay, Section 1, the economy's crossroads. And really, this is all about why central banks are caught between a rock and a hard place.
Yeah, they're stuck in what economists call a policy trap. And it's the perfect way to describe this mess. Think about it. If they cut rates to boost a slowing economy, they could pour gasoline on the inflation fire. But if they keep rates high to fight that inflation, they might just shove this fragile economy right off a cliff into recession. There's just no easy way out of this.
And this really lays out the whole conflict, doesn't it? The economic data is telling two totally different stories at the same time. You've got one set of numbers over here, slowing growth, a cooling job market, that are basically yelling, cut rates now. But then you've got this other set of data, rising inflation pressure, tariff costs, that's yelling right back, hold on, keep rates high.
And look, the evidence for a slowdown is pretty serious. The U.S. economy actually contracted in the first quarter. These forward-looking indicators, they're all pointing down. And if you look north to Canada, the picture looks even shakier, with manufacturing in a real slump and job losses mounting. So all of this together builds a really powerful case for, doing something to help the economy.
But then, this number dropped, 0.9%. And that was the monthly jump in the Producer Price Index, the PPI, for July. We're talking about the biggest single spike in over 3 years. And let me tell you, it completely changed the conversation like overnight.
So why does one number matter so much? Well, the PPI is what you'd call a leading indicator. It's not measuring the prices you and I pay at the store, it's measuring inflation for businesses at the wholesale level. And this huge spike, it's basically the first real piece of evidence we have that companies are starting to pass on those higher tariff costs. It's a massive red flag that those higher costs are headed our way, to the prices we all pay at the checkout.
And hey, don't just take my word for it. The central banks are admitting it themselves. Just look at this quote from the Bank of Canada. They're literally saying they're trying to balance the downward pressure from a weak economy against the upward pressure from tariffs. That's the tightrope right there, in their own words.
All right, so let's game this out. Section 2, Path 1, the growth bet. So what happens if the central banks look at all this and say, you know what, a recession is the bigger threat, and they decide to cut rates?
Okay, in a rate cut world, there are some pretty clear winners. First up, tech and other growth stocks. They get a huge boost because lower rates basically make all the money they're going to earn in the future worth more today. Then you've got real estate, or REITs. They love cheaper borrowing costs. And of course, anything tied to big consumer purchases, cars, homes, cheaper loans make it easier for people to buy that stuff.
Okay, but what if they go the other way? That brings us to Section 3, Path 2, the inflation fight. Now, this is a scenario where central bankers look at that scary PPI number, they worry about their inflation-fighting credibility, and they decide we have to hold rates high, even if it means slowing the economy down.
This scenario could lead to stagflation. That's the nasty mix of slow growth and high inflation. And in that kind of world, a completely different group of assets starts to look good. You've got your real assets, like gold and commodities, which tend to hold their value when inflation is high. Then there are inflation-protected bonds, TIPS, which are literally designed for this. And you have your defensive stocks. Think about companies that sell things we have to buy no matter what, like food and healthcare. They have what's called pricing power, meaning they can raise their prices to keep up with costs.
And of course, for every winner, there's a loser. If they cut rates, cash becomes trash, right? Inflation just eats away its purchasing power. But if they keep rates high, those growth stocks we talked about get hit with a nasty double whammy. The slow economy hurts their sales, and the high rates make their future earnings look less attractive. So, yeah, the stakes here are really, really high.
So the big question is, if you can't possibly predict which way they're going to go, what are you supposed to do? Well, that brings us to Section 4 and a really smart idea called the all-weather barbell strategy. The whole philosophy behind it is super simple. Don't predict the future, prepare for it.
Visually, it looks like this. The strategy is split into 3 parts. You have a big 50% chunk right in the middle. That's your core portfolio, the steady foundation. Then it's balanced out by 2 25% satellites on either side, one for growth to catch the upside and one for defense to protect you from the downside.
So let's break that down a bit more. That big 50% core, that's all about stability. We're talking quality dividend stocks and safer bonds. Then you have your 25% growth satellite. That's basically your bet that Path 1 happens, that they cut rates. So you put your tech and real estate here. And finally, the 25% defense satellite. This is your insurance policy in case Path 2 happens. It's where you put things like gold and tips to shield you from stubborn inflation.
And here's how that might look in a detailed allocation. You see, the core is anchored with quality dividend stocks and some short to mid-term bonds for safety. The growth bucket has a nice slice of tech and real estate ready for those potential rate cuts. And then the defense bucket is loaded with your inflation hedges, gold, commodities, tips, and even a little bit of cash just to be ready for any opportunities. See, it's a portfolio that's not trying to guess the future, it's built to handle it whichever way it goes.
Okay, last section. Let's build your investor's dashboard. These are the key signals you need to watch for the rest of the year to get a sense of which way things are heading.
So here's your watch list, 4 key things. First, those inflation reports, the CPI and PPI. Is that gap between what businesses pay and what we pay getting bigger or smaller? Second, the labor reports. Is the job market just cooling down or is it starting to seriously crack? Third, check on the consumer. Are people still out there spending or are they pulling back? And finally, business activity. Are the big sectors of the economy expanding or contracting? The answers to these questions will give you some huge clues. And you're definitely going to want to circle these dates on your calendar. These are the big decision days for both the US Fed and the Bank of Canada for the rest of 2025. And check out how close those meetings are to each other, especially in September. It's going to be a really interesting few months for sure. And that really brings us to the final, most important question. As we stand at this economic crossroads, where you can make a good argument for 2 totally different outcomes, you have to ask yourself, is my portfolio built to predict one of those outcomes, or is it built to endure no matter which path we go down?